Hello and welcome back to the first subsection of the second section of the FX mentorship. In this specific section, the focus is going to be on our actual POIs in the market. And these are all derived and found from understanding supply and demand zones in the market, how they form, why they form, how to find them, which ones are higher probability. And then, of course, as we work through them, we will see how we partner them with our potential idea of structure. And after that, we will start to introduce the idea of Wyckoff. Now, again, as you look at my markups here, no matter what day, no matter what time frame we're on, forget about the fact that you don't understand what is going on here, why I have areas like this highlighted, unless you already do. All you have to recognize is that all we've spoken about so far is the idea of structure, the way structure is delivered by way of larger time frame structure, by way of lower time frame candle structure, right? As you all remember, we spoke about this, the validity of it through multiple ways, as well as structure by way of delivery in the FX block. So these are all options for you, and these are actually all great to use in tandem to decide where your potential bias in this market is going to lie and where you want to expect the markets to move down the line. Now, the next step of actually refining that bias and coming to an understanding about areas where you could potentially expect buying or selling to happen from comes from the idea of supply and demand zones. Now, supply and demand zones are known on YouTube as many different things, and many other YouTubers call them multiple things. But the reality is they're just derivations of the original concept, which is supply and demand. And the idea of supply and demand ultimately is that as price is moving, the composite man needs to get involved into positions in that in a given market. So as price is being delivered in any given way, the move against price through liquidity and the continuation away leaves behind what we refer to as a demand zone. And that demand zone is seen as this entire area here. Now, refining that to the last down move before the up move, such as the final red candle before the moves up, have been coined to have many different names. I actually learned it originally from Levi Peters as the sniper, but the reality behind all of it is that this in itself, this zone right here, right, that last down candle is what we call a demand zone. Now, the opposite of that is when you have price on the top side, right, the move against price, right, the last up move before the down move, and that is what is known as, whether you take the rather large portion as the overall supply zone, or if you take the last, as you all understood, up candle before the down move, which, again, if you use the open to the top, is your supply zone. So these are the two main things you need to understand about these two zones. And again, we're going to get much more in depth on this and how they're important and how to look for supply and demand zone 2.0 off of certain areas and how to partner that with your idea of structure and everything of that sort. Now, as we take a look at what you see here, a supply and demand zone, as you guys can understand, is ultimately the last down move before the up move and the last up move before the down move. The reason they are called this and the reason we are interested in these is because they are ultimately the footprint of the footprint of smart money that they've left behind in these areas. And what I mean by that is as this price is delivered in a certain way. So imagine this on any time frame, it does not matter. Daily, 4 hour, it doesn't really matter. Price will create intermediary term lows and highs. From now, for now at least, forget about the idea of structure and just begin to think about this in the form of liquidity. Now, as price delivers these type of things, there are going to be traders at all times in the market getting involved emotionally or even with their own strategies of equal bottoms, of trend lines, of something of any sort like that, getting involved in buys or sells within this market. And always remember that even if you see this on one time frame, right, and you only think about these areas as being the areas of liquidity, what you're not seeing is that even on a lower time frame, for instance, inside of this area here, right, if we were to draw that area out here, the way this would look on a lower time frame could be something of this sort, right? Price comes into this swing low, right here, and then on the way up, right, during this move up, it's actually doing something of this sort, which means you're also going to have multiple people getting involved on the inside price action, on the trend lines that form on the way up, on the equal lows again that form on the way up, and so on and so forth. So again, the price is fractal, and as it is delivered, even when you see it in a simplistic form like this, remember that there's actually a lot of inner price movements and action, which is also acting as the same thing where liquidity is being built up. Now, what is liquidity? A lot of you probably already understand this, but you need to understand it to understand everything that we do. So make sure you take notes and you follow along. A swing high or a swing low can be denoted by literally a normal swing in the market. That can be denoted by ultimately this candle formation where you have a long wick and you have wicks on the two sides which are lower than that wick. So you have basically a 1, 2, 3, and these are lower, and that basically denotes a swing. If we go to a chart very quickly and take a look at this just on the daily time frame, the swings that exist in this market are as follows: this one, 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 both of these, this one here, this one inside, no, actually that one doesn't count, this one right here, this one right here, this one right here, right? The ones that are easy to see, this one, this one, this one, this one, this one, but inside you have this one, this one, this one, even this one, even this one, even this one, right? So you have to understand that these swings occur absolutely everywhere, and the lower on time frames you get, the more swings you'll start to see, right? If we zoom into all those that we saw inside there, you'll start to see that even on this time frame, now we have this swing, 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 and so on and so forth. There are a tremendous amount of swings in this entire market. Now, why does this happen? Well, it is the work of the composite man, basically liquidating emotional traders and retail traders and things of that nature. So what's actually occurring here is when we create an area like this, what we assume under smart money conditions or under what the composite man wants to do is that these zones are building liquidity. So above every single swing high and under every single swing low, what you have are stop losses and sell stops. So that's right under a swing low, and above a swing high, you have the opposite. You have stop losses and buy stops. Why is this concept extremely important? Well, if you all remember from earlier discussions and anything of that sort, when the composite man takes price to an area like this below swing low, the reasoning for that is to take out the orders that rested below here in these forms right here, to take out the stop losses for profit, right? Because the stop losses, when someone loses, someone gains, which means the composite man is gaining on those stop losses. And then to use the people that are selling and entering sells here, expecting for price to continue dropping to completely new lows. Instead of that happening, it comes here to grab them to enter buys. And the composite man does what at these areas? Looks to enter buys, and after the composite man has entered buys here, then he can begin his new move up. But to make this move occur here, which is the same as what we drew here, this is that move, again represented in two different ways, right there. To make that move occur, they had to, the composite man or institutions or smart money, whatever you want to call them, they had to sell into these positions extremely, extremely heavily. So from around here or even all the way to the open of this candle, they had to sell into this. So what they did is, and again, this is an idea that has stemmed all the way back from even like Wyckoff 100 years ago. So just so you guys know. So when they got into these sell positions, they basically opened thousands and thousands of lots of positions to take the price lower. And when they open these positions, right, they're taking positions that are going to be sells. So as the sells go lower, what are they doing at these areas, right? There's people that have stop losses here, like we said, right? And they also have sell stops, looking to sell into lower prices. And again, this is a concept derived that I first understood from Levi Peters on Proficient FX. So make sure you check him out. Great guy. Now, understanding that, we have price breakdown through, that area, collecting those orders, but also closing some of the sells that the composite man got into using the profit-taking stop losses of some people that had stop losses under this low. Because what did we say? Above and below every single swing in the market, according to our way of looking at the footprints of smart money, exist what? we at least presume that there are stop losses and buy or sell stops at those levels. Now, at the same time that we're doing this, you always have to consider the market fractally. Just because this is a daily chart and this is what we see, it doesn't mean that there weren't even more things in between, right? So in this price action, there could have been even more liquidity zones that were taken out along the way. That way, when this buy happens, there's even more liquidity zones that they can use to target for future prices. And again, we're going to cover more of this in the future, but this is going to be the first time you basically see something like this. Now, this down move through the lows, right, which takes out that liquidity, and then this big move up had a lot of money that had to be pumped into it to make that move occur. So when something like that happens, what we leave behind is known as a demand zone if it's for potential bullishness. And on the other side, if we have something of that same sort happen, where you have stop losses above these highs that are liquidated for potential take profits, as well as buy stops that are liquidated for entries for the composite man to go short, then you form what we call a supply zone, which means in that area, there are orders left that need to be mitigated out of because they are going to be negative in the future. What I mean by that is as price begins its markup or begins to move higher, as you can see right here, as it moves higher, it leaves behind the orders that they sold into to create this demand zone. And when they do that, their buys are making tons of profit, right? And where are they taking those profits? Above highs, above highs, above highs, above highs, above highs, but also above. As price moves up, you know it creates more liquidity. So they're taking more profits above these highs, and so on and so forth. And this is how, again, we're starting to form potential bullish structure, right? So that's how structure is sometimes formed. So as we're doing this and moving higher, we're using all these areas to exit positions. But what we don't realize is that although we're making money on our overall buy positions at all these areas of liquidity, we're losing money on this earlier sell. So by the time this price reaches potentially this area, this original sell, right? Because selling means you're only profiting if it's going lower. You're only making money on the buys, but the sell is worth, let's say, negative $50 billion at this point, right? That is, I mean, it's a lot of money, but this is fine for the composite man because he understands how he's going to mitigate this position. Now, what will happen, again, is along this way, as we spoke about in the structure videos before this, so you have to go check out that section, is we'll have inner structure as well, right? Creating those lows on the way and continuing higher. So again, as you understand this idea a bit above and below swing highs, what exists, you have stop losses and people that want to sell. So as he begins to take the price lower, he's doing it to start closing potential sells, not these ones, but sells he took up here. So again, remember that the composite man does not trade anywhere like us, right? He doesn't look for the best setup, then get involved, and then partial out along the way. No, the composite man is constantly buying and selling in the market. At some points, he's buying and selling much more than other points. That is why price is delivered to you so fractally on every single time frame, because he's not just buying and selling here, and then selling a lot here, and then selling a lot more here, and then buying a shit ton here. He is, right? He is doing that. He's buying a bunch here, of course, especially because there's sell stops. But he's also getting involved here, in buys and buys and buys. He's getting involved in buys on the way down. He's getting involved in buys here. At the same time, he's getting involved in sells and sells and sells and sells and sells, 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 and sells, and so on and so forth, right? Just back and forth, back and forth. Lots of buys and sells. Because as he does that, what he does is he delivers price to us in a certain way that makes us believe certain things about price before he can go and liquidate those positions to enter more, and so on and so forth, right? What the composite man does is consistently create swing highs and lows in the market to function as areas of profit taking and new position entries. And the reason that we can't just use these ideas of liquidity to predict price momentum is because they can happen in every direction, which is why then you'll begin to learn that partnering it with structure, right, is going to completely change how you view those liquidity creations, and you'll start to know which liquidity is important and which one you need to target for future price action. Now, again, that's going to be down the line, but this is already starting to get your mind thinking about how price is delivered to you. So when he's getting involved in all of these areas, he's fractally and on the daily time frame and on any time frame creating these movements in the market, right? Bullish, bearish, bullish, and so on and so forth, to create what? More areas where he can, again, take profits and get out of profits. But at the same time, those fractal moves are part of larger buys and sells, which are creating given patterns, given areas of liquidity, creating emotional traders want to get in. The FOMO, right? I mean, we've all had this, the FOMO to get involved in all this other stuff. So that way, when he really wants to create the larger move, again, this is the composite man, he'll sell extremely heavily, buy extremely heavily, and start to take real profits in what might be established as a new bullish trend. And as he does that, he will create areas of supply and demand. And now the reason we call these areas of demand and supply are because there are orders in these areas, right? Because he's at negative 50 billion that need to be mitigated and closed, because literally there are not enough people on the way up to just close all these cells, or even there's not enough people here to close all these major cells because it costs so much more money to sell into all these positions. But they do that because they want to accumulate even more buy positions. That's why we undergo Wyckoff, right? So we're going to talk about that as well later, and we'll talk about how that fully works. So when that happens, we leave behind this area, this zone of demand where prices literally have to come and mitigate from an institutional perspective. So these negative $50 million positions that are still being held, the composite man doesn't care, because he knows that on the way back down, he can bring it back to this area and exit those positions. So that is why price will oftentimes come back to a demand or to a supply zone to close out of the positions in here. Now, when we come to these zones, we can come to these zones to close out of positions at the open and then continue, or we can come deeper to close even more positions and maybe the halfway and then go off on our bullish play, or we can come even deeper to nearly the bottom and then continue. This is something we can't always predict. This is something we might be able to, we will look at in the future for refinements to see where we can potentially see this mitigation. But the reality is we don't always know how deep this mitigation has to happen, because we don't know how many orders or where these main orders were entered. All we know is that this area is going to function as a major point potentially in the future where positions are going to have to be mitigated, and where we can expect potential bullishness from if our mindset is that, or our bias is that we want to be seeing bullishness on a given time frame. So price again will tap into these areas, the open, the 50%, or even lower based on what's inside here. So we'll talk about that soon, and then continue to new highs. And then at that point, what happens to this? It becomes zero. It's break even. They finally mitigate those positions. That is also why you can sometimes see prices go off and come back in short term. It's all dependent on how many positions they had and how much they need to close, or how much they closed prior, right? If there was enough people on the opposite side to close all of these out when they got here, then and where you want to expect the markets to move down the line. Now, then how we begin to merge this areas of supply and demand zones with our ideas of structure, candle structure, Menta FX block structure, and Wyckoff. Okay, so these are supply and demand zones. Let's take a look at them on the charts for examples of how they look and how their mitigations look. Now, again, when we look at these in the charts, you might not see them play just like this perfectly, because remember, we don't just trade supply and demand zones. We trade the multi-level confirmations of supply and demand zones, right? We look for the refinement of them. We look for the structural confirmation of them. We look for higher time frame confirmation of them, and we look for lower time frame confirmation on Wyckoff. And that's something we're going to be working with down the line in this mentorship. So let's take a look at a few supply and demand zones on the real chart. And from there, you guys can go back and study multiple things like this. So we're going to start with the 4 hour, and we're going to work through some time frames just to explain how this works and what's actually going on to a lot of you. Okay. So let's find something that's actually a really good example. So you know what? This is a fine example. Honestly, there's tons of really good examples that we can use. And, I'm looking for the perfect ones for you, because I need you to understand the concept, because again, we don't just trade these ways, but you need to understand them to trade them or to analyze the markets properly in the future. Okay. So ultimately, what do we have? Let's go and find a really nice one on the 4 hour. I mean, honestly, we'll just start around this area right here. Okay, it's fine. Especially tiny moves like this is fine as well. So let's think about what happened here. Okay, we had prices come down into these areas, right? We had prices come and liquidate some lows, right? And then we had prices come off and keep going higher. Okay, now just looking at this, where are the supply and demand zones, or in this case, because we're bullish, demand zones that exist in this market structure right here, or not even the market structure, just in this market right here? Okay, well, there's a few ways to think about them, so we are gonna have to talk about that in the future, but ultimately, let's go like this. As we came in here, okay, you have to think about this. Again, here are the lows, potentially, that got liquidated. Now, that liquidation of the lows happened with the final down candle like we spoke about. Now, that down candle was technically this one, and it's already been mitigated, but that is what we like to refer to as a demand zone. Now, we can keep following that to the next demand zone, which is this one, for instance, right here, okay? And that demand zone is the last down candle before the up move. So actually, it's not in this case, but if we go to a 2 hour or maybe even a 1 hour, we'll be able to see that. So there it is, right? So you can see the last down candle, this one right here, so we'll just highlight that. That's all we're doing right now. Before the up move is what we consider to be our demand zone. Now, again, there are multiple ways that people look at demand zones. And I'm just showing you this right now so you understand how we at MentFX look for them. A demand zone, like I said, is the last down candle before the up move. And in this case, this is the last down candle on this time frame before the up move. So the idea behind this is that there were tons of orders that were sold into here to grab whatever liquidity existed on lower time frames, okay? Just because this down move didn't take out any liquidity does not make it not a demand zone, because on a lower time frame, it took something out. It always has. But if you don't like that, you could have, theoretically, okay, if we follow this, used this demand zone, okay? So if we just play this and you saw it at this point, this is perfectly valid, this demand zone right here. Okay, this is a demand zone. It's the last down candle, and in this case, it did take out liquidity before the up move. And at this exact point, this demand zone is valid to expect to see mitigations of the sells that they had to enter into this candle before the move up, right? So they need to come mitigate some of those sells either at the open, the 50, or even lower. We don't know, and we'll see how to refine that later, to then see potentially higher prices be delivered, right? So on a 1 hour, that is a demand zone. And the way you tell a demand zone is literally by looking at the last down candle before the up move that occurs, okay? So there it is. We tap into it and we see higher prices being delivered, okay? Now, something about demand zones or supply zones. Once a demand zone now potentially liquidity existed on lower time frames, okay? Just because this down move didn't take out any liquidity does not make it not a demand zone, because on a lower time frame, it took something out. It always has. But if you don't like that, you could have, theoretically, okay, if we follow this, used this demand zone, okay? So if we just play this and you saw it at this point, this is perfectly valid, this demand zone right here. Okay, this is a demand zone. It's the last down candle, and in this case, it did take out liquidity before the up move. And at this exact point, this demand zone is valid to expect to see mitigations of the sells that they had to enter into this candle before the move up, right? So they need to come mitigate some of those sells either at the open, the 50, or even lower. We don't know, and we'll see how to refine that later, to then see potentially higher prices be delivered, right? So on a 1 hour, that is a demand zone. And the way you tell a demand zone is literally by looking at the last down candle before the up move that occurs, okay? So there it is. We tap into it and we see higher prices being delivered, okay? Now, something about demand zones or supply zones. Once a demand zone or a supply zone is mitigated, it has technically counted as a mitigation. If a new one is created, then that's the next area we technically want to watch, right? So there's ultimately two places on a supply and demand zone that are important. It's the open and the 50%, or anything inside right here, okay? And that demand zone is the last down like that. That's all, so you understand. Okay. mitigated, it has technically counted as a mitigation. If a new one is created, then that's the next area we technically want to watch, right? So there's ultimately two places on a supply and demand zone that are important. It's the open and the 50%, or anything inside it that you refine, which we'll talk about later. If those places are mitigated, then that supply and demand zone is ultimately spent. That's how we would think about it. Or it's it's used up and we need to wait for the next one. So in this case, this mitigation showed us exactly that, and we would delete this demand zone. And the next demand zone, like we looked at from the 4 hour, is that last down candle before the up move. Now, you can use the down candle, but if there's another wick that goes lower than that last down candle, you can incorporate that as part of your demand zone, because what that means is on one time frame, there's actually probably a down move inside here. So the idea now is that we want to see prices come and mitigate these areas or potentially lower before seeing prices be delivered higher, because what happened in these areas again? They again had to sell into the big buys, creating another demand zone that they left behind. So again, if this is confusing right now, do not worry, for we will explain a lot more about this as we work through the sections or the subsections in this demand and supply zone subsection, okay? So price does indeed come back to it, testing the open, potentially come and test the 50%. Does it? Yes, it does, as you can see. Actually, maybe it didn't. Maybe very close. We can take a look. So what's interesting is if you use the actual last down candle, notice where it tested. If you use the overall area, it did not. So again, this is where it's going to come down to preference and understanding your supply and demand zones. But this is ultimately a demand zone that was tested now, and now price is moving higher. Now, same thing applies. This last, because this is now spent, and this candle has been traded above. So also something you guys have to remember, and something you still should be taking notes of, once a down candle is traded through as such, that is a valid demand zone, right? That validates the demand zone. So this area right here, this last down candle before the up move, is now our new demand zone. So the expectation is that they had to sell into this to buy, and now they may come back to it to mitigate some of those positions to continue in a given direction, right? So this is how demand and supply zones exist, okay? They exist everywhere. And we'll take a look at that in a second, but you just need to understand the basic understanding behind them, okay? So it comes to mitigate some of it, mitigates even more of it, to actually come and mitigate this prior demand zone right here, and it might go higher now. So again, supply and demand zones on their own are not guaranteed to get you into good and the best positions, but understanding them with the other stuff is going to be the difference between whether you're successful or finding successful ones or not, right? So let's get a little bit higher and just think about what we have going on here. Notice where this tapped, which was this last buy to sell movement, right? This last up candle before the down move. That right there is a supply zone, okay? The same way. They have to buy into this position before selling off, and now we expect that there has to be mitigation at this level before seeing either lower prices or lower prices before higher prices. Because again, remember that just because there's a mitigation of a supply or demand zone does not mean price wants to continue in that given direction. Just because it mitigated this does not mean it wants to get below here. It can, right? And if you're structurally bearish, then that's something that you can aim for. However, a demand or supply zone does not guarantee whether or not price wants to go higher or lower. Now, as we're taking a look at some of these mitigations and how they occur, let's draw out a few more demand and supply zones. Here's your last down candle before the up move. That is a demand zone that was mitigated because there were positions here that needed to be mitigated before the up move. Okay. Similarly, you have this last down move before the up move. Notice how price came back after trading above it to mitigate before delivering higher prices. Okay. Now let's go to the left a little bit. We have the same thing happening here. Here's your last up move right here before the down move. Okay. So we're just looking at the last up move before down move of a swing. Now, what happens? Before price goes higher, it comes and mitigates this before going lower. So again, the entirety of what goes on in this market back and forth can be explained with the mitigation of supply and demand zones back and forth. Because what's happening is, like we said, if the composite man is entering in every single area of a market, then we can expect mitigations at multiple areas, even if they are not within structure. So again, supply and demand zones alone are not always good enough to just get involved. You need to wait for potential confirmations. This is something we'll, again, talk about down the line. So I think this functions as an okay first video for the idea of demand supply zones, but the reality is a demand and supply zone are formed from this basis, and this is why they happen, and this is why we expect mitigations, and, okay, they are characterized by nothing more than the last up candle before the down move or down candle before the up move. And when that happens, mitigations of those areas begin to invalidate them, okay? Because like I said, we can have multiple mitigations, but ultimately we are interested in pretty much the first or second mitigation because we understand that after mitigation has occurred, there's really no point to come back, right? So if we had this move and we came to mitigate it and we moved away, there's no point to really come back because we've mitigated the important demand zone. Similarly here, we can go through price and find any of these areas. This is a valid, oops, my bad. This is a valid supply zone. We can expect, if we had a bias, for price to come into here and give us some kind of mitigation. It doesn't have to go to new lows, but we can expect potential mitigation. Now, I don't know if we get that. We can, of course, exit this and take a look if we do very quickly. So actually, as you can see, when we came into that supply zone, we came into it, we mitigated parts of it, came away from it, and then finished mitigating it, okay? Making a move back down to potential demand zones, making a move back up into more supply zones, making a move back down, creating more supply zones, and leaving price. Now again, this is a supply zone that's unmitigated. There could be potential mitigations here in the future. So again, we're not just looking for these and trading them. If you are just to trade these, then you can see that they wouldn't always be the best. You need to understand what you're looking for at them, right? Again, in this area, it looks like we shot right through it. However, if we take a look at actual price action inside of here on a lower time frame, what you'll notice is price had to still mitigate it, right? This on its own is still a mitigation of that overall supply zone. And just because a supply zone was traded through did not make the supply zone wrong. The supply zone that you had in mind is fully correct. And the reason I bring this up is because a lot of you need to recognize that if I was to basically highlight the supply and demand zones, even on this time frame, you have this demand zone, you have these demand zones, okay? You have this demand zone, you have this demand zone, okay? You have this demand zone, and so on and so forth, over and over again. You have this demand zone here, right? And then you have this supply zone right here, which it looks like, yep. So as you can see, just got mitigated by price. So ultimately, supply and demand zones are nothing more than candlesticks, right? That are opposite the trend and continuing in a certain direction, right? Because to form these candlesticks, to make them happen when they occur, you have to sell into positions, taking out liquidity in any time frame. So in this case, this little sell to buy happened when we took out the liquidity here. And when we did that, notice what happened. We traded above, right? Validating this zone. And then we traded back inside it. So this was actually the mitigation of it. And this was already also mitigation of it. And then we continued. This is how we look at supply and demand zones. So again, don't let this confuse you too much, but recognize that supply and demand zones are nothing more than the last up candle before the down move or down candle before the up move. And what we expect at those areas is potential mitigation for either continuation or for liquidation. So in this case, this overall supply zone that we looked at on the higher time frame was for the purpose of a little bit of mitigation before continuation. Okay, so do not just look to trade these, right? Because you can't. You need to partner them with other things. So this is the first video on the first part of supply and demand zones, and we will continue to talk about them in the next video. So I hope this made sense, and I will see you guys in the next one. Thank you.